Good afternoon, everyone. Thank you for joining us again today for our webinar on the latest COVID relief package and what's in it for businesses. My name is Mark Heath. I'm a partner here at McKonly Asbury, and I'm Director of Tax Services. With me is David Blain, partner and Director of Entrepreneurial Services. Before we get started, I just want to mention if you have any questions for us during the webinar, please submit them through the built-in questions function in the webinar control panel, and we'll do our best to answer them during or after the webinar. There will be 3 polling questions throughout that we will be sure to bring to your attention. If you want CPE, make sure you're paying attention and listen for those so you can weigh in and get your CPE. If you're not familiar with McKonly and Asbury, we're a team of CPAs and business advisors serving clients from our offices in Camp Hill, Lancaster, and Bloomsburg. We provide a variety of services to the industry shown on your screen. We encourage you to visit our website at macpas.com to learn more, and don't hesitate to get in touch with us and let us know how we can help. All right, Dave, you ready?
I'm ready to go, Mark. I'm ready. No fluff. We got to get right into it, Mark. We got a number of slides. We got 1 hour to cover this. So let's get right into it. So what we're going to cover today is the new stimulus bill that was just signed by the president on Sunday evening. It's out there. The SBA and other government agencies are working towards getting the process in place to enact the law. So what we're going to cover today is we're going to cover the PPP loan updates that are out there. PPP2. We're going to talk about economic injury disaster loans, some updates to that, and a big change in the law, which is the employee retention credit. Lot of information on that in regards to the expansion of the credit, the eligibility in 2020 for a lot of businesses, and how that's going to work in 2021. So let's move right in. So let's talk first about PPP loan updates to start with, Mark. A lot of big changes here with the second round of PPP, which we'll get to discussing here quickly. But what we're going to talk about today is we're going to talk about just a summary to start with here. What the PPP loan updates relate to. It provides some additional funding into the Paycheck Protection Program, expands the use of the funds, which we'll talk about what those additional uses are, expands funding eligibility for certain nonprofits. 501c6 organizations get the ability to apply for loans now, and additional requirements for a second round of funding. All right, so Mark and I got to talking about this a little earlier today. So what they did is they implemented a second round of PPP and authorized additional money for this. However, there are some interesting concepts to the whole second round of PPP. So who's eligible, Mark? First-time qualified borrowers and businesses that previously received a PPP loan can actually now apply for this second round of PPP funding. Also, who's eligible for PPP lending would be first-time borrowers. So let's say, Mark, you didn't, the first round of PPP, when that money was authorized, you decided you didn't need the money, you did not file for it because they've extended the PPP program. They're allowing first-time borrowers to also participate in the program. Now, here's the key, and Mark and I talked about this today. Based upon what we're reading, it seems to me like first-time borrowers would be under the current CARES Act in which authorized the PPP lending, and that would be businesses with 500 or fewer employees. And this is an important number, Mark, because as we get to talking about this in a little bit, PPP2 is actually for businesses with 300 or less employees. It also allows sole proprietors, independent contractors, those are eligible self-employed individuals, just like the first round, to be able to apply, and also nonprofits, including churches, just like you saw the first time around, the 501c3s.
Yeah, if there's one thing we've learned in all of this, it's basically read the rules and let's not try to interpret too much. So when we read the new rules, it really looks like if you haven't gotten a PPP loan before, you're under the old rules, like Dave said. You have 500 or fewer employees, no revenue questions, nothing like that. You can just get the PPP loan under the old rules. And the new rules that Dave's going to be digging into here only apply to if you're going for your second PPP loan. Now, the other thing we've learned here is never to assume that what the law actually says is actually what's going to happen. it is entirely possible that next week or the week after, the SBA is going to come out with interim final rule number 842 and tell us that everything we just read isn't actually what we just read, and here's what they meant to say to begin with. So if and when that happens, we'll be back here telling you what they said.
Exactly, Mark. So again, you'll have to just pay attention to the rules. The reason why we believe that if you have 500 or fewer employees and you haven't applied for it before is because the way this act is written, Mark, is that it's basically adjustments or changes to the initial CARES Act. So if the initial CARES Act had this language or legislation in there for the first round of funding, it's assumed that it would continue with what you're already seeing here with this additional language to update the CARES Act from what was issued back in March. Who else is eligible, Mark? A combination of food service operations with NAICS codes starting with 72 that have fewer than 300 employees per physical location. And then you got the 501c6 organizations. This is a big one here, Mark. You know, back when the CARES Act was initially out, they talked about that 501c3 organizations could apply, but the C6s were unable to apply. They would be the chambers of commerces out there. They would be industry organizations such as like Associated Builders and Contractors or something of that nature. What they did in this recent act is they changed this to say 501c6 organizations that have fewer than 300 employees can now qualify for funding under the Paycheck Protection Program. And the way it works is that if you have no more, you have to have no more than 15% of your receipts related to lobbying activities and comprise no more than 15% of your organization's total activities. Again, so as long as your lobbying and activities stay less than 15%, you can probably qualify for Paycheck Protection funding. And also that no more than $1 million in total lobbying costs in the most recent tax year prior to February 15th, 2020. So for a lot of these organizations, they're 630 year ends. It's, you know, that you would look at what that 630 year end was prior to February 15th, 2020.
And this was a good catch, I feel like they made, because, you know, in the initial round, there was just, you know, this landmine of lobbyists, lobbying organizations who were going to get PPP funding. And so they just threw them all in the same bucket and said, if you're a 501c6, forget it. Well, like you said, Dave, I mean, that rules out pretty much every chamber of commerce that, you know, sure, do they try to influence legislation? Yeah. Are they lobbying organizations? Not. I mean, the vast majority of them, they're just not. And they're hurting just as much as everybody else. So I think this was a good change.
Yeah, I agree, 100%. All right, moving on. So what they call this is the Paycheck Protection Program second draw loan. All right, so this would be for those that have already had a paycheck protection loan. You either are in the midst of using that paycheck protection loan, or you have also used it, submitted for forgiveness, and got forgiveness. So you would qualify under this second draw requirement. And the way the second draw requirement works is that it's going to be for those organizations that have less than 300 employees, first and foremost. You have to have used or will use the full amount of your first PPP loan. And next thing is gross receipts. Now this is the big change here, is that what they're saying now is for you have to show that you've had a 25% gross revenue decline or gross receipts decline in any quarter in 2020 as compared to the same quarter in 2019. So a good example would be, is, let's say in the second quarter of 2020, you show that your gross receipts or your gross revenues have declined of 45% over the same quarter in 2019. You would then be able to qualify to apply for this second draw loan. Loans now are limited to 2 million. Last time it was 10 million. You could get up to 10 million for your first draw loan. Second draw loan, they're limited to 2 million. Borrowers may return all or a part of the previous PPP loan and to reapply for the maximum amount of a new loan that might be available to them. So the SBA and the federal government are really trying to kind of open up the doors here a little bit more to allow organizations that are really struggling and really hurting with the opportunity to get on this second draw loan.
So I got a question for you, Dave. What's gross revenue?
It's a good question. Good question. You know, I think, you know, I've seen it discussed as gross revenue, Mark, in some guidance. I've also seen it discussed as gross receipts. And, you know, I kind of look at the whole situation of, you would think it makes sense to say gross receipts, because this whole Paycheck Protection Program loan from the very start has all been based around cash, right? It's all been based around the use of cash. You would think it's gross receipts. But, you know, what if you're a accrual-based organization and, you know what I mean?
That's exactly
you
where I
had
was
good
going.
cash collections one quarter, but you didn't really have the billings.
Yeah, is this cash basis or is this accrual basis? That's kind of the big question in my mind. But I will say, you know, like we've seen with other things, as long as you point to the two number, you have two numbers. As long as you point to both of them and say they were both calculated the exact same way, you probably will have no problem. So obviously you can't use cash for one and accrual for the other. If you can say my accrual number was this and my accrual number last year was 25% higher, then you're probably good. Same way, if you want to flip it and look at just accrual both ways and you can get there, I think that's fine. What's left to be seen is there going to be a financial statement requirement here? Is there going to be a tax return requirement? Obviously, tax return is on an annual basis, so you can't really do it by quarter there. But so what are they going to use? Internally compiled financial statements? Are they going to ask for bank account information? You know, I don't know. So point being, be prepared, be consistent.
Exactly. All right. So let's talk about loan qualifications, Mark. So to qualify for this PPP2 loan, the loan qualifications are the same as the first round. And that would be it's going to be based on 2.5 times your average monthly payroll cost in the year prior to the loan or the calendar year. And I've also read where they give you like trailing 12 months. They say that, and you know, kind of consistent with what we saw initially, Mark, that it said you could take the 2019 cost for payroll and take 2.5 times that by, you know, for the average month, or you could take the trailing 12 months. So I think that you'll see more guidance on that, but I think that you're probably safe to say that you can use either 2019 or 2020. Accommodations for the food service industry, this is new, starting with NAIC codes of 72, they're actually going to be able to get 3.5 times their average monthly payroll cost. And that, I think, Mark, that's really good for the hospitality industry. I mean, that's a really hurting industry right now that can use as much of this stimulus money as you can possibly get. And as you read through a lot of the guidance in there, Mark, too, a lot of it is targeted towards entertainment, hospitality, restaurant venues, any types of venues like that, or a lot of this guidance and legislation is really targeted towards them and get benefit.
Yeah, which, you know, check off another thing for them. They did their homework. They're trying to make sure this is targeted to the industries that are hit the worst. And clearly, you know, the accommodation, food service industries, hotels, they seem to be hit the hardest.
Exactly. And payroll costs are defined consistent with what it was on the initial Paycheck Protection Loan Program: gross wages, healthcare costs, retirement program costs, anything that the employer is paying on behalf of the employee, and then also those taxes that are related to like unemployment taxes that are paid by the employer. So nothing too different there in regards to what qualifies. The use of the loan, the use of the funds, very similar to what we saw before too as well, Mark. It has to be at least 60% towards payroll and no more than 40% to other eligible costs. There's also this covered period of 8 to 24 weeks. However, there's a little bit of a change on that 8 to 24 weeks. It's not going to be based on, and we'll talk about this in a little bit too as well, but Mark, it's not going to be based on when you actually get the money funded to you. It's going to give the borrower the option of determining what that time period is going to be of when you want to determine your covered period. The other thing too, Mark, is eligible cost consistent with the previous cost. Again, We talked about gross payroll, payroll-related costs as defined previously, rents, utilities, and other covered interest. Now, let's talk about what is a little bit different, okay? They also are now going to allow certain other costs to be included as part of the your forgivable cost. And what they've expanded it to include, outside of rent and utilities and covered mortgage interest, they've also said, we're going to allow you to use the money towards providing covered worker protection in the facility for PPP, PPE, anything that's related to like a federal health and safety guidelines to be able to operate your business. So that's number one. Second thing they said is any property damages that your business might have received in 2020 due to public disturbances that occurred across the country, anything that's not covered by insurance would also qualify as costs that can be forgivable. Also, they talked about expenditures to suppliers that are essential at the time of purchase to the recipient's current operations. So that could be, any types of material cost, and anything that you would need to purchase if say you're a manufacturer, Mark, and you need to purchase a certain amount of supplies to continue to keep your production facility going, and it could keep the supply chain going. That could be included as part of this cost. And then the last thing here, which I thought was kind of interesting, Mark, is they also included the fact that any operating costs, such as if you needed software for cloud computing services, you have a certain amount of human resource costs that have occurred because you're trying to figure out the FFCRA or accounting needs. They say accounting needs, and the way they define accounting needs in there is they talked about accounting needs from the perspective of calculations of payroll for determining credits or the PPP loan, or it could be anything in regards to accounting from the perspective of trying to track certain expenses related to the program here. So I wanted to make sure that we outlined accounting needs, because accounting needs have all of a sudden become part of the program in regards to what's a forgivable cost. So I would think, Mark, that part of those accounting needs might be the use of your outside accountant if you need to use your outside accounting firm to assist you with trying to track some of these costs.
Excellent shameless plug, Dave.
Yes, exactly.
But seriously, this really, they did expand the bucket dramatically, because the feedback they got was, hey, this is great for our payroll, but we need to keep the business open. Say, take a restaurant. So previously you had however many servers, but now you have one server, and that server is running food out to the curb. So the payroll, but you have all these other costs that you need to fund just to keep the doors open. So you need these costs to cover all these other business costs. So they did kind of recognize that and expanded, made the bucket a lot bigger.
Exactly. All right. So let's get to the first polling question. Again, let's make sure everybody's aware. This is your first polling question. There's 3 of them. You got to do all 3. Don't miss them. Question is, the Netflix series Cobra Kai is a spinoff of what 1980s movie? Is it Top Gun, Terminator, Forrest Gump, or The Karate Kid? So we'll give everybody about 30 seconds to answer this question. Mark, have you ever watched Cobra Kai on Netflix?
I haven't. We haven't gotten there yet.
It's I got to tell you, Mark, I've actually watched the first 2 seasons, and it is pretty good.
Is it what? How would you classify it?
Well, we'll classify it when we figure out what the answer is here, and then I'll classify it for you.
I'm mad I can't vote.
Well, what would you vote? What would you vote?
Is Forrest Gump an 80s movie? I was thinking that came out in the 90s.
I threw it in there as a question.
All right. Well done.
All right, let's get the answer. Let's get to the answers here and see what we got. All right. Yes, Karate Kid. That's what Cobra Kai is based off of. It's based off the 1980s movie Karate Kid. It takes you 35 years into the future, and it's actually, Mark, it's the same characters that played those. It's the same people that played those characters in 1980.
Except, Dave, I think your math is wrong. It's not 35 years in the future. It's the 1980s were not 35 years ago.
No,
Right?
actually, the movie was 35 years ago, Mark.
Because if it was 35 years ago, it means I'm a lot older than I
2020.
actually am.
All right, well, let's get moving on here. All right, so let's move on. Forgiveness process. Just like the first round, there is a forgiveness process. The loan is fully forgivable. The process is very similar to what you currently went through if you had a loan already and you went through the forgiveness process. Again, remember, these loans are administered by the banks. The banks would have to be the ones who initially review the forgiveness application. They approve the application and send it to the SBA for final approval. So it's very similar from that perspective. The couple things that are different, though, is that first thing, the selection of the covered period of the loan, 8 or 24 weeks, can be at the borrower's choosing after the loan origination. So again, just to make sure we're clear here, back before your covered period started when you got the loan dispersed to you, now their covered period can be in any between 8 and 24 weeks in any period after you get the loan. So that gives you a little bit more flexibility of how you want to use the loan proceeds or when you want to use the loan proceeds. So, but keep that in mind, a little bit of a different change here. So Mark, if you got funded on January 3rd for your loan, you may choose that, well, I don't want my covered period to start until February 1st. And then I'll look at my covered period at that point, whether it's going to be within 8 or 24 weeks. The other thing too, Mark, that's really that's been talked about for about 6 months now is this $150,000 forgiveness simplification process. So they did write that into the law. Basically, what that says is that if you had a loan of $150,000 or less, that loan will be forgivable based upon signing the certifications on the application and also providing a one-page write-up. And they are very specific to say no more than 1 page of that. The fact that you use the loan in your best estimates, you use the loan for 60% payroll, no less than 60% payroll, in that you were able to retain X amount of jobs. So however many jobs you're able to retain by having a loan, you put that in that write-up, and that's what you will now submit to the bank for approval. So it's a very simplified process from the perspective of what we've seen now currently with this whole long form from the 3508 or even the 3508 EZ, because EZ really at the end of the day, Mark, you still have to do the calculations of the FTEs and do the calculations. I think it's important to everybody to know that even though the forgiveness process is simplified, you still are, according to the SBA, required to have the documentation to support the information that you put on that forgiveness application. Whether it's like you say that I retained X amount of jobs or I used X amount for payroll costs, you still have to have that detail.
Yeah, just like Dave said, if it's not documented, it didn't happen. So make sure you keep the documentation regardless of whether or not you have to submit it. And this, this is going to cover what, like 85% of the loans that were made?
Yeah, because I remember reading some statistics that said that I guess over 80% of the first round of loans were 150,000 or less. So that would relieve a lot of pressure off the banks and the SBA. Because if you think about it, Mark, now that banks have to ramp back up for this second round of funding on top of doing forgiveness applications. So you're going to have to free up some capacity on both the banks and the SBA side to be able to do this. All right. Other notable changes. This is an important one. So repeals the requirement that the PPP borrowers deduct the amount of an EIDL advance from their PPP forgiveness amount. So if you recall, Mark, back in the, earlier, you showed your forgiveness, but your forgiveness was, if you got full forgiveness on your PPP loan, but you did get an EIDL advance of, let's say, a maximum $10,000, that $10,000 then became you had to pay it back. You had to pay it back as if it was part of the PPP loan at 1% over 2 years. The law now has changed that and said that no longer will be in effect. You do not have to, does not get included into your forgiveness calculation. And it does not get included as something that you have to pay back. Now, the good news here too also, Mark, is that almost all this legislation is very specific and states that it is related, that it is in effect for any loans that happen before at the time of or after the date the legislation is passed. So it gives you the ability to actually go back to your bank, revise your forgiveness application, and get the $10,000 forgiven. So that's off your books.
And you said, and we're talking, when we say the date of enactment, we're talking about the date of enactment of the CARES Act, not of this COVID relief bill.
Yes.
Okay.
Extends, the other thing too is extends existing safe harbors on restoring FTE and salaries and wages. Specifically applies to the rule for reducing loan forgiveness for the borrower and reducing the number of employees retained. All those safe harbors, because you remember all those safe harbors, they sunsetted on December 31st. It extends them out to the, I think it's March 31st or it's July 1st. I forget what the date is that extends it out, but it extends it out into the future, the safe harbors.
Yeah, this puts us back into the spot of, really the only way you're not going to get full forgiveness is if you just had work for people to do and you just decided to not have them do it and not pay them for it. Yeah,
exactly. Other items to note, Mark, provide additional clarity on the definition of seasonal employer. All right, so there's it tells you the rules are very specific on how you define a seasonal employer. Most revisions apply to loans made on, before, on, or after the enactment of the act. Again, what we just talked about earlier. Clarifies the use that group insurance benefits such as life, disability, vision, and dental are considered payroll costs. Clarifies the applicable period for the employee's salary of $100,000 to be annualized as a prorated during the period in which the compensation is paid or incurred. Extends the covered period of all PPP loans through March 31, 2021. And that would be initial PPP loans. And the PPP loans are non-compounding and non-adjustable interest rates. Again, a lot of stuff that we already knew, but now, there was always speculation there, Mark, and we've always talked about this in every webinar, a lot of these items. The current stimulus package does more specifically outline these items now, so it's more clear cut. All right, so that's PPP, Mark, to start with. Couple updates on the economic injury disaster front that we need to talk about. So a couple things that are important to note here is the first one is this extension of the debt relief programs. So if you recall, Mark, back when the CARES Act first came out, basically the SBA came out and said if you had some of these micro loans or you had some of these previous 504 7A loans, the principal and interest on those loans were going to be paid for actually by the SBA for like a 6-month period. Basically, what the Stimulus Act does is it resumes the payment of this principal and interest on small business loans guaranteed by the SBA, in that all borrowers with qualifying loans approved by the SBA prior to the CARES Act will receive an additional 3 months of principal and interest starting on February 2021, and then going forward, those payments will be capped at $9,000. So basically, takes that legislation that was initially in place, kind of extends it out a little bit further, that if you have some of these loans that you're already having relieved for you by the SBA. I know of a couple clients of ours that have this situation. This is going to be extended for you. I think it's also important to note that after a 3-month period described above, the borrowers considered to be unserved, namely the smallest or hardest hit by the pandemic, will receive an additional 5 months of principal and interest payments capped at the $9,000. Again, this would be for those micro loans, as 7A micro loans, as 504 loans, and it would be for those industries that are hardest hit, or the sectors that were hardest hit by the pandemic, and that would be things like the food service industry, accommodations, arts, entertainment, recreation. So I do believe we'll probably go to see a little bit more guidance on this that's a little bit more clear cut, but rest assured that if you had an SBA loan before that, you were having some of these principal and interest payments deferred, you're probably going to get a continued deferral on that. And then any new payments, any SBA payments for anything that's newly approved, will have a $9,000 a month cap as well, and will be allowed to defer that principal and interest as well. And then finally, just some quick modifications to the 7A loan programs. Increase to 90% the total guaranteed amount on 7A loans. Increase the express loan amount from $350,000 to $1 million. but it does revert back permanently to $500,000 on October 1 of 2020. And then if you express loan guarantee amount of $350 and less is temporarily increased from 50% to 75% for all loans above $350. The guarantee remains at 50%. So that's just a couple quick updates, Mark, on the economic injury disaster front. Last and finally, provides some recovery assistance under the microloan program, extension of participation in 8A loan program. The Act also has this targeted EIDL advance for small business continuity, adaptation, and resilience, and extends the period of the EIDL grants through December 31, 2021. So I guess it's important to note, Mark, from this that, you got the PPP program, but everybody should be aware too that the economic injury disaster loan program has been authorized and refunded as well, and that there is some changes to that program that are actually somewhat beneficial to businesses that either A, had a SBA EIDL type of loan, or B, want to apply for one.
Yeah, why don't we take a pause here for a minute and answer some of these questions, because we have a bunch of questions.
Sure.
On PPP stuff, and the second half of our program we're going to be moving away from PPP. So why don't we bang these out now?
Sure, let's do it.
So there's a couple on here about business acquisitions. That's going to be a special nuance that we're going to have to address individually. I'm not sure we're prepared to answer those today. So for PPP2, can a calendar quarter be any 3-month period? And do PPP1 funds count as 2020 gross receipts?
So PPP1 funds, I would say, do not count as gross receipts. They're going to be looking at what the gross sales receipts of your business are. I would say that what they're going to be looking for is comparable. How do you manage your business? If you're a calendar year taxpayer, or you have calendar year financial statements, probably they're going to be wanting to look at Q1 being January, February, March, Q2 being April, May, and June, and they're going to want you to be able to do comparatives in that manner. I don't think they're going to give you the ability to just pick any 3-month period, but then I could be wrong, Mark, because I would assume that that's probably something we're going to see more guidance on.
Yeah, like I think this is now the third time I'm going to say if there's one thing we learned, but if there's one thing we learned, a lot of these questions end up being answered by the application, because they're going to have to come out with a new application. They're going to have to come out with new instructions. And so you usually just the flow of the calculation on that application is going to answer a lot of these things. But
right.
Yeah, I'm seeing a bunch of questions on the definition of gross receipts, definition of political expenditures, definition first-time qualified buyers, et cetera. I think we're going to have to table those and wait for either the interim final rule or the instructions. And let's see what else we have here.
Yeah, Mark, just to follow up on that, I agree with you 100%. I think that, this is going to be no different, Mark, than what we did the first time around. I remember when we first did these webinars back in March and early April. It seems like 10 years ago, but I remember that, there was a lot of guidance that still had to come out in regards to the definitions of what defines gross receipts. I'm sure that we're going to have the same situation here of what defines lobbying expenses, what defines gross receipts. So again, everybody should be aware that what we're doing here today is based upon our detailed reading of the guidance that's out there in the law, in the enactment, in that more likely than not, probably in the next 2 weeks, we'll probably have a second webinar after we see the new applications when they come out and what that guidance says in those applications.
Yeah, and to clarify, whenever we say prior year, we're referring to 2019. That's the one consistent thing we're seeing. They're not, they're not going to compare 2021 to 2020. Everything's going to be compared back to 2019.
Yes.
A couple questions on the 8 or 24 week period. We consistently use, because that's what's stated in the Act, is 8 weeks or a 24 week period. But in reality, your covered period can be 2 weeks. If you can spend all the money in 2 weeks, then you're done. If you pick a 24 week period and you can spend it all in 12 weeks, then you're done. Somebody says, why would anyone use 8 weeks? I don't know, other than.
Yeah, I agree with you there. The whole application process is so much easier if you can show that you used all the money on payroll. If you have to ship all these other expenses, it just makes it really difficult. So you might as well extend it out for 24 weeks and use that.
Yep.
So
yeah, if you can spend it all in, like I said, in 2 weeks in some crazy scenario,
yep.
and you want to get your application in and get it forgiven, sure, choose the 8-week period.
Okay.
Was there a revenue decrease requirement on the first round of PPP? No, there was
No.
not. So here's an interesting question. Where'd it go? Someone had asked how much should they apply for if their employee, if overall the company is down in terms of headcount, revenue, everything. How much should a company apply for if you've downsized? Would it be wise to apply for what would equal 60% of current payroll plus 40% of other costs? I kind of feel like that's overthinking it. I like the thinking behind it, but I'm kind of thinking, this is a loan that you can get forgiven. So I would say apply for as much as you can get, as much as the math will get you, apply for that much. Use every dollar that you can for payroll. If you have employees who you've laid off, go find them, bring them back, get them back on payroll, even if it's just for 8 or 24 weeks. Bring them back, get them back on payroll, and see what happens. And if you have some money left over at the end that you couldn't spend on whatever, then you just pay it back. The interest rate is really good. So that would be my recommendation. I don't know if you agree or not, Dave.
No, I agree with you 100%. That just makes, you might just do it all on payroll. I 100% agree with you. Here's one on the first PPP. The covered period began on the funding date, right? Yes, that was correct. We don't get to choose. Now, yes, that is correct. Now, however, with passages of the stimulus package, they did put in their language. It said that the rules in here apply to the loans before, on, or after the date of the enactment of this. So if you haven't applied for loan forgiveness on your first round of PPP, I believe you're going to be able to now determine what that 24-week or 8-week covered period is going to be based on your choosing. That's the way a lot of the language reads throughout this whole document.
Mm-hmm.
Yeah, there's another question here about purchasing another business. That's going to be an interesting question, Mark. That's going to have to get addressed because, yeah, what if you did purchase another business in 21 and that gets in that, or 20, and that got mixed into your 20 results? Of course, you're going to show revenues that are up, but if you extracted that out and looked at it normalized just for the base business, well, you might be down 26%. You know what I mean?
Yeah, that might go back to, did you buy stock or did you buy assets? If you bought assets, you might be out of luck because everything just gets rolled in. If you bought stock, it'd be a lot easier to split it out as a separate legal entity and look at it that way. So what about a 501c6 that doesn't have payroll but pays officer stipends? Presumably they would be 1099 independent contractors, so presumably they'd have to go get a loan on their own.
Yeah, exactly. I was thinking the exact same thing.
So
here's a question about what if we are a new business and do not have a previous year to compare to 25% gross revenue numbers to? Keep in mind that the act itself, when it was first passed, the CARES Act, and the rules are still the same here. Your business you have to have been in business on February 15th, 2020. So that might be an answer to your question there, because if you weren't in business before February 15, 2020, then you're not going to be able to qualify at this point in time. Now that rule might change, but that's the way the rules read right now.
And a perfect segue, what if you took the employee retention credit? Can you still do a PPP loan? You're going to find out in a minute.
Yeah, exactly. It's a beautiful thing. So I'll tell you what, Mark, let's get to the next polling question, because I don't want to shortchange you on the ERC. I think that's really important for everybody to know. So anyways, this is a question for Mark. So Mark, currently in the English Premier League, which team has the most points, or those in webinar world, it would be the team that's in first place. Is it Leicester City, Manchester United, Liverpool, DC United, or do you not care? Now, I'm going to just tell everybody the answer is not don't care. Don't come out with that answer.
So first of all, Dave, it's Leicester City. I mean, if you're going to put the name on there, you got to learn
you
how
might
to
as well say
pronounce
it right. No, I agree with you. Okay, Leicester City.
Second of all, there are going to be some people that are very upset with you for leaving one team off, for not even in consideration. And that
City,
team would
Manchester
be
City.
No, the Tottenham Hotspur.
Yeah, there's a guy in our office that loves the Hotspur. He knows who he is. He's probably on this webinar right now.
Yeah. So just for those people out there, I did not make these, but one of these teams plays in 21 minutes. So,
all right, let's get to the answer. Let's get to see what everybody says. Everybody said Manchester United, 25%, Liverpool, 27%. So there we go, Mark. Yes, it is Liverpool that's on top right now. Mark's a big Liverpool fan. I had to throw this question in there when I was putting these questions together. So that is the answer. All right, let's get on here, Mark. This is big stuff now with this employee retention credit. I'm going to turn it over to you and let you run through this. I'll advance the slides and you go ahead.
All right. So the employee retention credit, this is a big deal. We've spent not a ton of time talking about this because the PPP was the big headline. And before this latest COVID Relief Act, you could not do both. They made that very clear from the beginning. So that's kind of the overriding theme here. Second, there's two pieces to this that you must understand. There's a 2020 piece and there's a 2021 piece, and they are not to be combined, confused, or otherwise whatever. So for 2020, there's no change to the calculation of the credit. They only changed who can take the credit. For 2021, the calculations changed for the better, and the same expansion from 2020 is included in 2021. But again, these changes to the calculation only apply to 2021.
All right.
So how does this work with the Paycheck Protection Loan? The old rule, don't even think about it. The FAQ on the IRS's website says, if you applied for, not even if you got, not even if you're going to get it forgiven, if you applied for a PPP loan, just don't utter the words employee retention credit, because we're just not going to give it to you. All of a sudden they decided, hey, you know what? We've got plenty of money. Everybody, sure, come on in. So that is big news, because the employee retention credit, now if you took a PPP loan, you can get the employee retention credit. You can go back in time retroactively and apply for this employee retention credit.
That's huge.
Is the big, yes.
Yeah, because now you have the ability. You have the ability of the forgiveness on the PPP, and then you also have the ability of the calculation of the ERC credit in 2020 as well. But there is some more guidance on that, so don't get too excited yet until Mark tells you a little bit more about it.
Yeah. So that's what you need to understand. So the first thing, you need to understand that you need to look at this. Next questions are you eligible? So since we didn't talk a ton about the employee retention credit, let's do a quick overview of 2020. If your business was fully or partially suspended during at least one quarter in 2020, or you had a 50% or greater decrease in gross receipts in a 2020 quarter when compared to that same quarter in 2019, you are eligible. So that's kind of the first question. And we hear, what does partially suspended mean? I like to go back to the restaurant example of your restaurant. You serve food and you serve in-person dining. If they shut down in-person dining, but you still do takeout, that qualifies as partially suspended. So I think a lot of people can get there to that partially suspended test. Next question is, do you have qualified wages? If you have 100 or fewer employees, all wages paid during the quarter that you qualify are eligible, all of them. If you have more than 100 employees, only the wages you paid to employees not to work. So your business was shut down or you had to furlough people, but you continued to pay them, those wages count if you have more than 100 employees. If you send everybody home to work remotely and people working remotely, and you have more than 100 employees, those wages do not count because those people continue to work.
Right.
So, obvious question is, well, what about the wages paid with the PPP loan? That is where we get this catch here. So if you got forgiveness for payroll costs, those payroll costs are not eligible for this credit. But as we experienced with many people going the 24-week route, you have, say you have a $500,000 loan, but over 24 weeks, you have $1 million of payroll. So you slap that $1 million on there as your payroll costs, and it's a no-brainer that you get full forgiveness. Well, we need to go back and look at that and say, you have $500,000 in excess payroll costs. Not only do you have that, could you take the payroll costs for which you're claiming forgiveness back down to the 60%, get the 40% with non-payroll costs, get full forgiveness, and now you have a whole bunch of payroll costs that are potentially eligible for the employee retention credit. So this is a complete and total potential reversal from the methodology that many people have employed for their PPP loan forgiveness.
Yeah, I guess the key here for everybody to know is that you can't use the same payroll cost that you got for PPP loan forgiveness as part of your employee retention credit. It has to be payroll cost that's related to PPP is related to PPP. You cannot take that as part of your ERC credit. It has to be separate payroll cost. So, but Mark, you make a great point. And, we talked about this initially when the ERC thing came out months ago. We were like, you know what? There is some benefit to actually taking this ERC credit over the PPP. But now think about it with this. You could basically almost get some type of credit of some sort on all your payroll throughout the most of the year on top of the PPP stuff. So exactly. It's really beneficial. All right.
So again, looking at 2020, what's the calculation of the credit? You can get 50% of up to $10,000 in qualified wages per employee for the entire year. So you can get up to a $5,000 credit for wages paid to an employee for a quarter that where you were affected, but that $10,000 cap, $5,000 credit, is for the entire year. That'll change in 2021, but that's the rule for 2020. So the logistics of this, we don't know. Presumably, you're going to go back, you're going to file a 941X to claim this credit. What if you've already filed your application for forgiveness? Are you going to be able to amend that? That makes sense. How else would you do this? So if you did file your application, I don't think all is lost. I think you can go back and do this. I feel pretty confident that they're going to allow for that. Otherwise, what was the point of even?
Well, especially when you look at a lot of the language inside the stimulus bill, it talks about the changes in here are for activity to happen before, on, or after the enactment of this act. So it almost tells you that you can actually go back in 2020 to previous periods and file a 941X mark.
Yeah. So. All right. So now that was 2020. Clean break. We're now on 2021. These new rules only apply to wages paid in 2021. So what happened here is they extended the date for the employee retention credit to June 30th, 2021. And my not so funny joke in there is that when the pandemic
is ending,
we know, and the changes in this calculation again only apply to 2021. And again, we continue now with you're allowed to do both. You're allowed to take the employee retention credit in 2021 and get a PPP loan, with the caveat that you can't use the same wages for both. So again, 2020, you had 50% of qualified wages. In 2021, they're increasing that to 70% of qualified wages. And the cap is still $10,000 per employee, but for 2021, that's $10,000 per employee per quarter. So that's going to be now a potential $14,000 credit per employee that you pay at least $10,000 if you qualify in both quarters.
Right.
Try and keep up, Dave. And
All right,
then
I'm on it.
So now, what are the tests to qualify for 2021? Same idea. In 2020, we said your receipts have to drop by 50% or more when comparing a 2020 quarter to the same 2019 quarter. And once you qualified, you continue to qualify in subsequent quarters until your gross receipts exceed 80% of the receipts from that same quarter in 2019. For 2021, you have to have your receipts, gross receipts only have to go down 20% of the same 2019 quarter. So you're not going to compare 2021 to 2020. You're going to compare for Q1 2021, you're going to compare Q1 2021 to Q1 2019 and see if you drop by more than 20%. So that's going to be the test. Obviously, it wouldn't make sense to compare 2021 to 2020, particularly
Right.
in Q2. So that's why they put that in there. Here's an interesting thing. I don't know what they did here. There's this option to use the prior calendar quarter. So for Q1 of 2020, or sorry, for Q1 of 2021, you can look to the prior calendar quarter. So in Q4 of 2020, if your gross receipts dropped by more than 20% compared to Q4 of 2019, that means you qualified for Q1 2021. Yes, it's very confusing, but there's different caveats in there. You just got to make sure you're looking at your gross receipts to see if you qualify.
Yep.
On the shutdown test, there's no change. Any quarter where there was at least a partial shutdown, you qualify for the employee retention credit. The employee threshold, like we said in 2020, if you had 100 or fewer employees, all of your wages qualify. If you had more than 100 employees, only the wages that you paid to people not to work qualifies. For 2021, that $100 employee threshold increases to 500. So if you had more than
big.
That's 500 employees in 2021, you're still stuck with the only wages paid not to work. If you have fewer than 500, then it's all wages. So that's good news. So it's huge expansion for 2021.
So Mark, why do you think that they did that for 2021? They didn't just do that for 20 and make it 500 or fewer employees?
I'm guessing it's a revenue thing, because that would be, that would be a huge difference, because, and I'm sure they said too, there's a ton of businesses that weren't affected financially by this. Many of them larger employers. So if you're going to say, well, we're just going to give you a credit for all of these wages, you have 450 employees. We're now going to give you a credit for all of your wages paid, even if you just had a partial shutdown, but you're still able to operate at full capacity. I feel like that's a huge number for businesses that probably don't need it. They're doing okay.
Mm-hmm.
So that was real quick on the employee retention credit. But just, again, the big thing is know it's there, know it's available. Let's start looking at the numbers.
Do you want to, I'll tell you what, we could do this quick poll here and then we'll answer some of the questions that are coming up here relating to the employee retention credit. So this is the third polling question. Again, you need to make sure you've done all three to get your CPE for today. So the big question here today, final one, is this American-born soccer great is from Hershey, Pennsylvania. Is it Christian Pulisic, David Beckham, Mark Heath, the great Mark Heath on this call today, Clint Dempsey, or is it both A and C? So we'll give everybody a couple minutes here.
This is a recycled question, Dave.
No, it's not recycled. I actually, it's been out there. It was out there in a different form.
In different
I changed
pieces.
this one around for you.
Okay. All right.
All right. Well, give everybody. All right. Let's go to the answers here. Yes. So 44% said A, and Christian is from Hershey, but the answer actually is E, because Mark Heath is from Hershey, PA, and he was one of the greats at Hershey High School in Messiah College, and you have to include him on there. So It's the answer is really both A and C, Mark.
I guess it depends on what your definition of great is.
I'll tell you what, Mark, let's go to a couple questions here. There's a lot of questions that have come in related to the earned, related to this employer retention credit. I heard it only applies for the first 2 quarters of 2021. I think that's correct, according to what we just presented here. Where do we apply? Where do we apply for the ERC? So, Mark, this is one thing that's going to be interesting, because really you apply with it. I think it's with the payroll companies. Most of the payroll companies, ADP, Paytime, Paychecks, should be able to do the employer retention credit application for you. But man, I got to tell you, Mark, if you're talking about a lot of work now, because the payroll companies have a lot on top of them, on top of the PPP, because they're also providing a lot of the payroll data for PPP. Exactly.
But yeah, Dave, to your point, that's the place to start, your payroll provider, because this is going to be a refund or a credit against your payroll taxes that you actually pay in or deposit with your 941.
Okay. Kinds of entities are eligible for the employer retention credit. Our 501c6 is eligible.
It's all employers. There's no restrictions to my knowledge. If you're paying payroll, now again, it has to be payroll because it's against payroll taxes. But yeah, if you're paying payroll, then you're eligible. Next question, is this for only 1 quarter or more? Let's say I got a PPP loan, used it for the 24 weeks in Q2 and Q3, but Q4 continues to be down. Yeah, you're a prime candidate for this. This is where you go back and look at all of your payroll costs to see if you have any excess payroll costs that you can then use to get an employee retention credit.
Here's another question. So we took advantage of the tax credit. We could apply. Can we apply for a PPP and use the wages above the $10,000 as eligible cost? As long as you're not, as long as there's separate costs, as long as there's separate payroll costs, correct, Mark? Mm-hmm. You would be able to use it to the PPP loan.
Yeah, and you're just going to have to keep the documentation and spike out what costs you used for payroll forgiveness and what costs you're going to claim the credit for. Again, this is where it's going to get very complicated from the perspective of the payroll that goes to the PPP and the payroll that goes to the earned or to the employer retention credit, because the payroll companies are going to have their hands full trying to figure this out. Yeah. So if you took advantage of the of the tax credit, if you already took the ERC, and would you still be able to apply for a PPP loan? I wouldn't see why not. That's kind of the thing here. If you decided the ERC was better for you previously, I think you could still do it. I don't see why not. We're going to need some specifics on how to do that. But yeah, and hopefully the bank is going to have some of these answers to some of these logistical questions too. So yeah, as always, as we say a lot, check with your bank. If in my forgiveness application I had a $500,000 loan, I showed total payroll costs of $750. Am I able to use the excess $250? Yes.
Yeah, absolutely.
Yep. Make sure you still meet your 60%. Obviously you do here. Make sure that you don't have any FTE reduction or salary wage reduction that would take you below the 500. But yes, that is the exact scenario here. If you qualify, you get full forgiveness. You qualify for the credit because you had shut down or drop in gross receipts. Yes, let's talk about how to use that $250 and get employee retention credit for that.
Yeah. I think the common theme here, Mark, is simple: that you just, as long as you're not using the same payroll costs for both the PPP and for the ERC.
Exactly.
As long as it's not the same cost, you should be fine to take advantage of both.
Yep.
All right.
Last couple minutes here. There's a couple other tax-related changes included in the COVID relief bill. Expenses paid with your forgiven PPP loan are deductible for tax. And I cannot believe that it took us 58 minutes to announce this, because this is like the biggest deal in the world that just kind of became like a ho-hum, oh yeah, and as a result of all of this. But yeah, the forgiveness is still not taxable. The expenses you paid with the PPP loan, they are deductible. So check that off the list. The employee payroll tax deferral, this was it. I don't even want to talk about it. This was the thing where the employee portion of the payroll taxes, you didn't have to pay in, but then the company had to pay them in the first 4 months or first 3 months, whatever, 2021. Well, the payback of that is extended to 2021. I know of exactly 0 companies who took advantage of this. So if you did, you got some extra time. The FFCRA credits. This was for small employers. This was actually the first COVID relief bill. This was for smaller employers who were mandated to pay sick time and leave for COVID related stuff. You can continue to get those credits through March 31st, 2021. And then business meals. Yeah, they just threw this in there. Sure, get 100% deduction in 2021 and 2022. I mean, just one of like the rules, the forever rules of taxes are business meals are only 50% deductible. Not true anymore. They're 100% deductible in 2021 and 22. And the above the line charitable contribution for 2021 of $300 is now extended to through 2021. And you can get $600 if you're married filing joint. And the charitable contribution limitation was increased to 100% of AGI for 2020. That's pushed into 2021 as well. So get your charitable contributions out there. All right, as we've said, stuff's going to change. We're going to get more information. We're going to be having more webinars, so stay tuned. In the interim, if you have any questions, please do not hesitate to shoot those questions over to us. So if there's nothing else, Dave, I'm going to do our official closing.
Yep, go ahead.
Thank you, everyone, once again for joining us for this final webinar of 2020. If you have any questions, don't hesitate to reach out. Recap of the presentation will be posted on our website in just a few days. And for those of you who need CPE, those certificates will be going out in the next couple weeks. Thank you again for joining us. Happy New Year, happy end to 2020. And from everyone here at McKonly and Asbury, thank you for all your support this year.
Have a safe and happy New Year's Day.